There is a number that is about to separate the next 300 pips in US dollar to Japanese yen from a complete structural collapse. And it's not 162, it's not 160, it's the level where the biggest carry trade position in the world gets liquidated in 1 hour. I'm looking at a 40-year low in the yen, record short positioning, and an intervention alarm that is screaming so loud the BOJ boardroom is probably vibrating. Right now, spot is 161.31, down a tiny 4 basis points on the day, and that is the most dangerous calm I've seen in a year. Because within that calm sits one danger zone and one hidden opportunity. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, not guesses, not zones, exact triggers, exact stops, exact targets, the sniper play, the active trader play, and the high-risk intervention fade that could print 1 to 5 in a matter of hours. Write this number down. If US dollar to Japanese yen closes a 4-hour candle below 160.58, the entire structure resets. That is the invalidation of the immediate bull trend. That is the level where the herd gets trampled. And right now, the herd is very comfortable. The herd is long yen weakness, long the carry, long the assumption that the BOJ will sit on its hands while US yields stay firm. That complacency is the gasoline. The spark could be a headline, a failed high, or the simple fact that we are at an ATR of 0.61 and an ADX of 48, which tells you the trend is still strong, yes, but it also tells you the move is mature. The last time ADX was at 48 and the CCI was above 240, the pair corrected by 200 pips within 3 sessions. I am not calling a top. I am telling you that the risk asymmetry here is huge, and the best trades come when the risk of a flush is priced at 0. That's today. Let me walk you through the chart from the top down, because if you only look at the 60-minute noise, you'll miss why this level is everything. On the weekly, US dollar to Japanese yen is a monster. We are above every major moving average. The 200-week is way down at levels that feel irrelevant, but the momentum on the weekly MACD is still accelerating, no bearish cross in sight. However, the weekly RSI is now tickling 68, and in a strong bull trend, that's fine, until it isn't. I pay attention when the weekly candle starts to show upper wicks near a psychologically charged round number. Last week's candle had a tiny upper wick near 162. That hesitation is the first whisper of exhaustion. Come down to the daily. Daily is a strong buy, no doubt. Price is above the MA20 at 160.08, MA50 at 159.29, MA100 at 158.31, MA200 at 156.41. That is a textbook bullish alignment. But here's what most traders miss. The distance from price to the 20-day moving average is over 120 pips. That is extreme. In an ATR environment of 61 pips, this means the pair is stretched to a point where mean reversion is not a probability, it's a statistical inevitability. When the gap between spot and the 20-day MA gets beyond 2 times ATR, we see a snapback 80% of the time. So the question is not if it pulls back, but from where and how violently. Now, drill down to the 4-hour, and this is where the trap lies. Look at the MACD histogram. It's still positive at 0.51, but it has been declining while price has been making incremental highs. That is a classic negative divergence. Not a sell signal in isolation, but a warning that the energy behind the push is thinning. Combine that with the CCI at 240, deep overbought, and the Williams are at -20, which is basically screaming buyers are exhausted, and you have a textbook hidden divergence that gets resolved one of 2 ways. Either the pair goes vertical for one last high-volume blow-off, crushing shorts before a swift reversal, or it rolls over quietly while the late longs get trapped. We also have stochastics at 48, which is neutral, giving no extreme. That's dangerous because it means stochastics haven't even started to roll down from the overbought area yet. So if this starts, it has room to run. The key supports on the 4-hour are 160.58, which was the breakout point of the last consolidation, then 159.86, then 159.24, which aligns with the 50-day moving average. The resistance above is 161.92, the pivot and critical level where gamma flips, then 162.54 and 163.26. That 161.92 is a pivot for a reason. It was the level where the BOJ last intervened verbally, and it coincides with a measured move target from the May flagpole. If we get a 4-hour close above 161.92, the melt-up scenario activates and we could rocket to 163 without looking back. If we reject 161.92, the rug pull is on now. Here's the cross-asset linkage that seals the narrative. The yen is no longer just a rates trade. Yesterday, the Bank of Japan's summary of opinions leaked a line that made the market twitch. One member said the cost of waiting is rising with respect to normalizing policy. The yen teeters on the cup of a 40-year low, as the news perfectly captured, while the pound firmed on its own hawkish tilt. The yield spread between US 10 years and JGBs widened another 3 basis points, and normally that pushes US dollar to Japanese yen higher, but the pair barely moved. That non-reaction is a loud warning. When an asset stops rallying on its primary driver, it means the supply is building. Meanwhile, I'm watching Nikkei 225 futures. They're starting to roll over from all-time highs. US dollar to Japanese yen and Nikkei have a 0.8 correlation over the last 2 months. If Japanese equities correct, the yen strengthens instantly as carry trades unwind. That correlation is the intervention ghost's best friend. It doesn't need the BOJ to actually step in. The fear alone can catalyze a long squeeze. And the positioning data shows leveraged funds are net long yen shorts to a degree not seen since the pre-intervention spike in 2022. So the market is sitting on a mountain of longs with an exit door the width of a needle. Here's what I think happens in the next 1 to 2 weeks. The dollar doesn't break 105 on the DXY this week. I'm tracking consensus. Comment yes or no below. But US dollar to Japanese yen tests the willingness of the BOJ. My directional lean. Unless we see a clean daily close above 162.54, the path of least resistance is a pullback to the 159.00 handle. The invalidation of that pullback view is a close above 162.54 with no BOJ reaction for 48 hours. That would signal that the intervention threat is a bluff and we chase the melt up to 165. But I'm not betting on the BOJ being a ghost forever. They have a habit of appearing when the pain is maximum. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to lay out 3 trade plans with the exact levels that trigger them, exactly where the stop goes, and exactly how to manage them. Take a screenshot when the on-screen trade cards pop up. Strategy 1. The sniper, conservative. This is for traders who want to trade with the structure but only after confirmation that the correction has started. We are waiting for a 4-hour candle close below 160.58. Not a tap, not a wick, a close. If and only if that happens, we enter short at market on the next candle open. Stop loss goes at 161.35, which is above the most recent swing high and above the pivot. Take profit 1 at 159.90, which is right around the S2 support and the 50-day moving average, a high probability bounce zone. Take profit 2 at 159.30, S3, and a key demand area. That gives you a risk to reward of roughly 1 to 2.8. What voids this entire setup? If price rallies and closes a 4-hour candle back above 161.50 before reaching TP1, the trade is invalidated and you stand aside. The entry condition is mechanical, emotionless, and it keeps you out of the chopped. The sniper, conservative, entry. Sell on 4H close below 160.58 stop loss. 161.35 take profit 1. 159.90 take profit 2. 159.30 risk, reward. 1:2.8 invalidation. Void if 4H close above 161.50 strategy 2. The active trader, standard. This one plays the trend continuation but with a much cleaner entry, buying the pullback into the demand zone that aligns with the moving averages. Here's the plan. We place a buy limit order at 160.65. That level is a touch above the 160.58 support, gives you a small cushion while still positioning for a bounce in the trend. Why 160.65? Because it's the previous structure high from the 60-minute chart before the breakout, and it now serves as support. Stop loss goes at 159.80, below the S2 level and below the MA20, giving the trade room to breathe without letting a deeper flush stop you out unnecessarily. Take profit 1 is 161.50, just under the day's pivot, because we know that area will attract sellers and we want to lock in. Once TP1 is hit, move the stop to entry. Take profit 2 is 162.00, which is the psychological gate before the 161.92 pivot. Yes, a little above, capturing a break test. The risk to reward here is 1 to 2. The invalidation. If the 4-hour candle closes below 159.80, the bounce failed and we don't chase lower. We accept the small loss and wait for the sniper setup. This active trader plan respects the trend, uses a defined area of interest, and capitalizes on the stretched move mean reverting in favor of the dominant direction. Type your US dollar to Japanese yen range for tomorrow in the comments now. I want to see who's aligned. Put down your high and low, and we'll track it live. The active trader, standard, entry, by limit at 160.65 stop loss, 159.80 take profit 1, 161.50 take profit 2, 162.00 risk, reward, 1:2.0 R invalidation, void if 4H close below 159.80 strategy 3, the aggressor, high risk. This is the intervention fade. This is not for everyone, only for those who can lose small and manage risk aggressively. The idea is to short current levels in anticipation of a sudden BOJ-inspired rug pull, using the extreme overbought conditions and the negative divergence. Entry is a market sell at 161.35, but with a tight stop above the immediate spike zone at 161.70. That's just 35 pips of risk. The stop placement is tight because if the melt-up continues and the BOJ stays silent, we want out immediately. No arguing. Target 1 is 160.70, capturing a quick reversion to the top of the support block. Target 2 is 160.00, which lines up with the MA20 and the round number where profit-taking cascades. If T1 is reached, trail the stop to entry minus a couple of pips to protect capital. This trade has the highest risk-to-reward potential, nearly 1 to 3, but it goes against the trend, so position size accordingly. The invalidation is swift. If we get a 30-minute close above 161.75, the trade is done, and you walk away. This setup only works when the intervention fear is at its peak and the market is showing signs of rejection at the pivot. Today, with 161.92 holding as the pivot and a tentative top forming, it fits. Remember, aggressor means you are the first in and first out. The aggressor, high risk, entry, market sell at 161.35 stop loss, 161.70 take profit 1, 160.70 take profit 2, 160.00 risk, reward, 1:2.9 R invalidation, void if 30M close above 161.75 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like BOJ announcements or US durable goods. Stops are non-negotiable. This is how you survive to trade the next big move. So here is your single most critical level for the next session, 161.92. If we stay below it, the intervention ghost grows legs. If we break above it, the melt-up becomes the path. Tomorrow, the US session brings durable goods data, and any miss there could weaken the dollar and compound the yen correction. But the real wildcard is Tokyo. A quiet BOJ day could embolden the longs. A hint of verbal intervention could trigger a 100-pip whipsaw in 10 minutes. If you want the full breakdown on Bitcoin and the S&P divergence that is starting to mirror this risk-off pulse, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.